if the big four get in trouble, it would unfortunately create contagion for the whole U.S. and world banking system.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 24th through July 1st, 2024, while supplies last. First, we feature Ital Preziosi Silver Kilo bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance, and back with us today is our good friend Mario Innecco from the Innecco 64 YouTube channel. Mario, thank you so much for joining us today.
You're welcome, Elijah. It's nice to be back here talking to you.
Well, it's great to have you today. What I did want to first discuss is the Federal Reserve and the FDIC warning the big four large banks in the U.S. about their derivative positions, and that they really need to get those under control and figure out how they'd be able to unwind them in a crisis. Can you expand on this? Because I know you did a video on this explaining how the big four banks in the US have $168 trillion in derivatives. And just to that's such a large number. People might have a hard time conceptualizing that, but that's almost 6 times US GDP, as you noted. So can you expand on how, I guess, this issue is actually going mainstream now, and the Federal Reserve, FDIC, is taking note of it?
Yeah, they came out a few days ago and they said that their living will, which is like a process, I guess, if they were to go bankrupt, that they'd have a procedure to unwind everything. And they said that they haven't done a good enough job on the derivative side. And it's not surprising, because that 168 trillion I told you, I talked about in the video, and you just mentioned, that's the notional amount of derivatives. And what is notional? Well, it's how big the bet is that they're making, be it on interest rates, be it on currencies, be it on commodities, gold. And they will say, the bankers, that it doesn't matter, that notional amount, because as long as the counterparties that are involved in those bets can pay the margin changes every day or every week, and it's mostly over the counter. So these are not, I would say a lot of the derivatives are not like traded on exchanges like the Treasury futures or gold futures. A lot of them are over the counter, so we don't even know what's going on there. And I suspect, I can't say exactly. I don't work for the Fed or FDIC or the banks, but what I suspect is that the OTC derivatives are so opaque that the Fed's saying, and the FDIC, you got to give us more information about this, and this is worrying. And they're saying, basically, especially Citibank, they mentioned, or a Citigroup, that if they were to go bust, they haven't done a good enough job to clean up their derivatives book, and that's all of them, but they focused on Citigroup. So, and we don't even know what the big four banks have in terms of derivatives, maybe offshore, and some people suspect derivatives are worldwide are over $1 quadrillion or $1,000 trillion. The BIS, which is supposed to help regulate the too big to fail in the U.S. and elsewhere, they changed the rules after the '08 crisis, and they they changed the rules in a way that lowered the amount of notional derivatives that is reported. So I think it's a big mess. Derivatives are, of course, what kind of triggered as well the '08 crisis, and I don't think anything has been fixed.
No, you talk about in the video where you reported on this issue, You've talked about how the repeal of Glass-Steagall really initiated the potential for banks to play in the derivatives market. Can you expand on that?
Yeah, from 1933 to 1999, when Glass-Steagall was repealed, the Glass-Steagall Act, commercial banks were not allowed in the U.S. to trade derivatives for their books. I think they could do it offshore, in London and stuff. But that was a huge move. And Brooksley Born, the lady that was the head of the CFTC, she warned against that in Congress. But she was stared down by people like Robert Rubin, Alan Greenspan, and what's his name, Larry Summers, because they wanted the big banks to be able to get into this derivatives game because it's very, very lucrative, and especially if the government and the Treasury are going to bail you out. It's the old story of privatizing profits and making the losses public. And I think it was a huge mistake. That was in 1999. 9 years later, the whole banking system almost collapsed. And I would say the repeal of Glass-Steagall had a lot to do with that. They did come with new regulations after the '08 crisis, the Dodd-Frank regulations, but I don't think it changed anything. And like, for example, Robert Rubin, he used to be the head of Goldman Sachs in the, I think, early 90s, late 80s, and then he became Secretary of the Treasury under Clinton. And then you had Larry Summers, who became Secretary of the Treasury at the end. And it's interesting that Robert Rubin, after Glass-Steagall was repealed and Clinton retired, his second term ended, Robert Rubin went to work for Citigroup, and he was paid hundreds of millions of dollars just to sit there and basically not do much. But that was payback for allowing the commercial banks to trade derivatives. And nothing's has changed, Elijah. And I think, that's why Brooksley Born in 1999 said, "I'm concerned the American people's money will not be safe if you repeal Glass-Steagall, because prior to that, only investment banks, which didn't take deposits, could get involved in derivatives."
Now, when it comes to what this might mean for the average person who is invested in the big four banks, or has their money on deposit there, it's quite interesting, because when we saw the banking crisis last year, the narrative was that the big banks are going to be the most secure, right? Because they're too big to fail. And the regional banks, you could see, further failures there. It seems like this may be reversing the situation, where it seems like the big banks might actually be the ones that are most in trouble. What is your perspective on that?
Yeah, I mean, if there's a lot of volatility in the markets, and we're seeing that a little bit of late with the Japanese yen dropping to like almost 40-year lows. I see today that Treasury yields are going up. The U.S. Treasury is still doing loads of deficit spending. And to top it all off, we're seeing that more and more countries are trying to use their own currencies to trade with each other instead of accumulating dollars as reserves to trade with each other. So I think the derivatives could be they're like the gorilla in the China shop, because 168 trillion, that's 6 times the US GDP. You have a little accident in some markets and you get a counterparty failing. And when a counterparty fails, like Lehman did, it can create a huge contagion crisis where banks could all go under. And we saw that in '08. I remember very well, because I was working in the markets. Unless they had brought in that TARP, the 700 odd billion to save the banks, yeah, we might not be talking about the big banks anymore. They might have all gone under. It wasn't a crisis of Main Street, the '08 crisis. It was just the Wall Street banks were in trouble because they gambled and they lost. But yeah, like you said, it might be that the too big to fail are in trouble. Yeah, and I wouldn't want to have that much the money on deposit or unsecured loans as it technically is with these big four, and also actually with any bank in general, because if the big four get in trouble, it would unfortunately, it would create contagion for the whole U.S. and world banking system, I would say.
And you've also reported on the repo crisis, but I'd like to get your perspective on what could be happening in the repo market coming soon and what that means for the greater financial system. Yeah,
I saw the other day as well that some of the big banks on Wall Street, they're warning that the debt situation in the U.S. is getting out of hand, and that the deficit, for example, the CBO's Congressional Budget Office just came and said, well, a few months ago, we thought the deficit for this current fiscal year was going to be 1.5 trillion, but now it's 1.9. The Treasury is going to have to issue another $150 billion. So the repo market is a market where financial institutions provide liquidity to each other using treasuries as collateral. But if the Treasury is in need of liquidity to keep going and in need of borrowing, hundreds of billions, it crowds out that private sector funding market, which is the repo market. And they warned about that. And we saw in 2019, in September 2019, that's what that happened again. The Fed was doing quantitative tightening, the balance sheet was unwinding, and all of a sudden, financial institutions stopped trusting each other. They wouldn't even lend to each other if they had treasuries as collateral, and the repo rate went from like around 2.5% to 10%. And then the Fed had to step in, and they stopped. Well, they said it was not QE, it was just to provide liquidity, but they stopped the QT after that. And then the following year, early in the year, we had that COVID crisis, which was a good cover for them to pump even more trillions into the system. So yeah, that's something that I hadn't heard up until recently, maybe a problem with the repo market. And it looks like Wall Street is worried about that. So if Wall Street is worried, I think we need to, take note.
What kind of impact do you think a crisis in the repo market would have on the average investor out there?
The impact would be that the Fed would have to come in again. And, normally they would provide liquidity by doing more QE. So it probably would actually boost everything again, stock market, bond markets, gold, silver, and the dollar would be the main loser. And it would be more of the same. But I think this time gold and silver would outperform because I think people have to come to the realization that the Fed can't stop inflating. And if they come out again and save the system because of a repo crisis, I think people might wake up and say to themselves finally, well, this is never going to stop, which is what I've been expecting for ever since the '08 crisis, because historically that's what happened when you go down the route of money printing. Unless you let it all implode and collapse into a deflationary depression, you have to keep going. And eventually that collapses also into a currency crisis. And my money is on the currency crisis. A deflationary collapse, though, would also help gold and silver, because you'd see a lot of bankruptcies, banks and everything else, and you'd see a dearth of dollars, if you want to call it, fiat currency. But gold and silver would also be pretty much in demand, because no one would have any currency, because the Fed, if the Fed and the Treasury allows everything to implode. And I don't think they're going to do that, though. I think they're going to go the route of more and more monetary and fiscal stimulus when they see the first signs of trouble.
Now, mentioning a currency crisis, over in Japan, we are seeing that the yen is very weak, and people might think that this is good for the US dollar, but what is your take on how the weakening of the yen may also impact other currencies in the US dollar?
Yeah, I think the weakening of the yen is a sign that, it's a bad sign, because the yen is an important part of the international monetary architecture. And the yen has been used a lot as liquidity instrument for investors around the world, because the Bank of Japan, they've kept rates at zero or negative for decades, trying to extricate Japan out of the collapse of the stock market in 1989, 1990. And they never let things really liquidate. And they've come to the point where there's so much debt in Japan that they need to, by keeping rates at zero and still doing QE, it's going to destroy the yen. But I think it's just a harbinger of what's going to happen to the dollar, to the pound, to the euro, and all the other fiat currencies. The dollar might be the last one to bite the dust, because it's at the base of the system. But ultimately, I see gold and silver being the place to be.
It does seem like it might be a case study or an example of what could happen in the future. What we're seeing in Japan right now with their debt to GDP, upwards of 200%, right? So if they're having to kind of print the money to pay the debt, or to monetize their debt and keep interest rates super low, you can kind of see where the U.S. is headed in that sense.
Oh, yeah. And Japan was a pioneer in doing QE as well, in zero rates. And we follow them in the U.S. and the U.K. and Europe. And their excuse has always been deflation. And by deflation, they mean like the CPI being negative. But if Japan really was in a deflation, the yen would be really strong. And if you look at the yen in terms of, the price of gold in yen, it's at an all-time high. It's almost approaching 400,000 yen per troy ounce. And back in the '08 crisis, it was around 60,000. So yeah, and I think a lot of people, they're missing the big picture here. They're not seeing the forest or the woods for the tree. They're just focusing on the fiat currencies. But ultimately, when you have to keep inflating, and Japan is inflating, don't be fooled by this deflation talk. Yet when you have to keep inflating, ultimately the currency gets trashed. And that's why the dollar just traded at a 38-year high above 160 yen. What's interesting, Elijah, is that back during the Bretton Woods system, when the dollar and the yen currencies had a fixed peg, $1 was 360. So there's a lot of room. The yen had appreciated a lot against the dollar, but now it's giving up a lot of those gains historically.
In the gold and silver markets right now, we're seeing a pullback. Gold around 2,300, silver still below that $30 level. Do you anticipate that changing anytime soon? What do you think are some of the factors that's caused this pullback? Your take on the current state of the precious metal markets?
Yeah, I think there's a couple of things. The first thing is that they've turned precious metals, or it's been like this for decades. People speculate on gold and silver through the futures and over the counter like a currency. And there's always this volatility, which puts a lot of people off from buying physical gold and silver. So I think it's a trading game, but eventually you want to have gold and silver. You have to keep stacking. What we see day to day is speculators and bullion banks in the paper market, trading. But I think gold and silver had done really well, like from April to May, and they picked up very quickly. So they got ahead maybe of themselves. And what I'm seeing now is consolidation, so we can so that the moving averages can catch up with the prices. And silver, the long-term charts look quite bullish, and I think by the end of the week, if we're still above, let's say, 28.30 or thereabouts, it still looks very, very good. And don't forget, gold, I think, settled last year at 2,060. So we're still doing really well. And you're always going to have some kind of corrections in the bull market. And that's how I see it. And I think also seasonally, July is a good month for precious metals. So, but I always, when I get frustrated with the price moves in paper, gold and silver, I always tell myself, what's the alternative? Am I going to get rid of my gold and silver and put it with JP Morgan or Goldman Sachs or NatWest or Barclays? No, I'm not going to do that. So I just keep going.
All right. Well, Mario, really appreciate your time today. Before we let you go, where can our viewers find you online? And did you have any last thoughts?
Yeah, online you can find me at Innecco64 on YouTube. I post a video, every day there. On Twitter, I'm at Innecco1964. Last thoughts? Yeah, I mean, aside from gold and silver being a good protection versus currency debasement, it's also a vote of no confidence in our leaders. And personally, I've never really been happy with political leaders. So if you're unhappy with political leaders, that's another reason why you should have gold and silver outside the banking system, because if you put your savings in the bank, those savings are going to be used to finance the people that you're not happy with.
All right, Mario, thank you so much for your time today, and God bless.
God bless, Elijah.
This is Kaiser Johnson with Liberty in Finance, and these are the Miles Franklin Weekly Specials for June 24th through July 1st, 2024, while supplies last. First, we feature Ital Preziosi silver kilo bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10 ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.